In this video, we're going to look at doing the income statement. So in the exam, you might have to do a completed income statement, or you might just have to do part of it, either just the revenue part or the expenses part. Usually the beginning of the question will have you doing some ledgers or journal entries for balance day adjustments. So you have to know about two different types of income statements. First, for a service business, and for a service business, the income statement looks like this. We've got our revenue, which is usually fees received, any other income, dividends received, interest received, rent received, all go under other income. And then we do the expenses for the service entity. The Group 1 expenses are those that are for the delivery of the service. So, for example, if we were a plumbing business, they would be plumbing expenses, and they would be things like vehicle costs, costs of the plumbing supplies, costs of the wages for our plumbers. Administrative expenses are those that are used for running the office, including doubtful and bad debts. Finance costs is usually around interest. We also need to know how to do a trading one, and the only difference here is that we've got sales and we have to take away cost of goods sold to get what's called gross profit. Then we add in the other income, and then we have our expenses. This time, instead of Group 1 expenses, we've got distribution costs. So those are the costs for getting the products to the customer. So they might be delivery, they might be the salespeople's wages, it might be depreciation on shop fittings, depreciation on vehicles if we're transporting stuff. Administrative and finance costs are much the same. The income statement's purpose is to calculate the profit for the year. So we're only dealing with income and expenses. So in your OneNote, we've got got a worked example for a trading firm here, and I'm going to do in this video one for a service firm. Okay. So in the exam, you'll get a resource booklet which will have the resources for each of the questions, and each question's centered around a different business. So you'll get usually the trial balance with additional information. So the usual practice is to start with doing your balance day adjustments and then answering the questions in the exam paper. So in this one, we've got it starting with insurance of $4,200, excluding GST, so we don't need to worry about taking the GST out. It's paid in advance. Insurance is an expense, so it's going to be a prepayment. So that means that we need to decrease insurance by $4,200. Okay, so we're just going to find insurance. And insurance is $10,700. So we're just going to take off the $4,200. So insurance is now going to go down to $6,500 because it's a prepayment. So that would have been the credit. We would have credited insurance. So it means that we're going to debit the prepayment, and a prepayment is a current asset. And so we're going to credit it by $4,200. So all our expenses are on the debit side of the trial balance, and all our income is on the credit side. Right, so the next one is boat tour revenue, $6,900, including GST. So we've got to take the GST out. It's been received in advance. Boat tour revenue is here on our right-hand side, so on our credit side, so we know it's income, and it's in advance, so we're going to call it income in advance. Now we're going to take out the GST. So it's 6,900 divided by 1.15 is 6,000. So our boat tour revenue has to decrease by 6,000 because it's in advance. So that's going to be our debit. So 180,000 minus 6,000 gives 174,000. So that's the debit of 6,000, and then we're going to credit income in advance, which is a current liability, by 6,000. Right, next one we've got interest is owing on the loan at 8% flat rate. Our loan is for 45,000, so we need to find out how much we should have paid. So we should have paid 8% of 45,000. Which means that we should have paid 3,600. We need to go and have a look at our interest on loan, and it's for 3,000, so it needs to go up by 600. So we're going to debit interest on loan 600, and we're going to credit accrued expenses, which is a current liability, by 600. Right, invoice on hand for boat hire revenue, including GST, has been recorded for 2,300. It's for boat hire revenue, which is an income, so we know it's going to be accounts receivable that we're dealing with. So our accounts receivable is going to be debited by the GST inclusive amount, so the full amount of 2,300. We're going to credit our boat hire revenue, and it's going to be for 2,000. And then we need our GST of 300. So the boat hire revenue is GST exclusive. So now we have to increase our accounts receivable by 2,300. So we've got 15,700 plus 2,300. It's 18,000 for our accounts receivable. We're going to increase our boat hire revenue by 3,000. So we're going to get 59,000 there. And we have to decrease our GST by 300. So we're going to get 3,300 because the GST is a credit at the moment and we debited it in the journal entry, so it's going to end up being decreased by 300. Right. Our allowance for doubtful debt is to be adjusted to 2% of our accounts receivable. So our accounts receivable is at 18,000 and it needs to be 2% of that. Okay, now normally sometimes you'll get bad debts. They need to be taken off first before you calculate the doubtful debts. So our allowance for doubtful debts should be 360. Okay, but it's actually at 400. So we're going to have to decrease allowance for doubtful debts by debiting it by 40. And that means that our doubtful debts, we're putting it on this side, even though it's going to be a credit, because it will still end up in the expenses, but it will be like a negative expense. Okay, so that allowance for doubtful debts one, the journal entry would look like this. Debit allowance for doubtful debts to reduce it. To reduce it, we would debit the allowance for doubtful debts by 40, and then we'd credit doubtful debts by 40. Right, now we've hit our depreciation. So remember, we've got different types of depreciation. We've got straight line, we've got diminishing value, and we've got units of use. Our first one is a diminishing value one. So the diminishing value one is when we take our historical cost minus accumulated depreciation to get our carrying amount, and then timesing that by the rate. In our case, we're looking at the depreciation on the boating equipment. So the historical cost for our boating equipment is 75,000 minus its accumulated depreciation, which is 10,000, times it by its rate of 20.